the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market ended the day as well as some of the companies to watch. But as always, here's a quick recap. Singapore shares dipped as Asian markets traded mostly in the green. So the Straits Times Index was down 0.5% at 4,449 points at about 11:55 a.m. Singapore time. And that's with a value turnover of some 639 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended in the red as well, down 0.35%. We're looking at 4,440 points. In terms of value turnover, that's 1.46 billion Sing dollars. Gainers outnumbered losers, 336 versus 257. Top advances for today, we've got for you F-Point, Jardine Cycle and Carriage and Venture Core. And top decliners, we have here GMH-USD, DBS and Hong Kong Land USD. Well, in terms of counters to watch for today, we do have Keppel Reit, and we'll tell you why in just a bit. And also on deck, how Chinese stocks fared as investors returned after a long break, and whether the ongoing AI rally has gone too fast and too far. Well, a lot of questions, and joining me on the line today is Terence Huang, CEO of Azure Capital. Terence, welcome back.
Hey, Tian Tian.
Hey, and Terence, let's start with global news this time around. Nvidia CEO Jensen Huang, he told CNBC in an interview that he was surprised that AMD offered a 10% stake of itself to OpenAI as part of this strategic partnership they announced this week. How far is the ongoing AI boom a bubble then?
Well, I wouldn't really call this a full bubble yet, or a bubble, but there are clear signs of overheating in parts of the ecosystem. On the fundamentals, demand is real. Microsoft said, AI added 16 percentage points to Azure's growth. Data center capex is projected to top 300 billion next year, and Nvidia's, Blackwell chips are already sold out well into 2026. And these are actually firm commitments, not just hype. But we're also seeing late cycle dynamics. Deal structures are turning unusual. Customers being offered equity or warrants like OpenAI with AMD. And while billions are going into training ever larger models, monetization from AI applications is still only beginning. I started my career during the dot-com bubble. But this seems less like this dot-com bubble and probably more like the early smartphone era, a genuine platform shift, but with uncertainty over which apps, which players will actually capture the profits. So for now, it's an infrastructure boom with speculative pockets. Risk lies more in the enablers, the chips, data center builders, utilities, where valuations have, run very, very hard. But the application layer, in contrast, could still be, very much underappreciated. The real test, I believe, will come over the next 2 years. If revenue growth at the application level catches up to the surge in capex, this remains a sustainable boom. But if not, then and spending continues to outrun profits into 2026, that's when I think the bubble label will start to stick.
And if we look at TSMC, it reported today that third quarter revenue went up by 30% year-on-year, beating market forecast. But I do want to talk about Oracle instead, because Oracle actually saw shares slipping earlier in the week on the back of news that cloud margins on Nvidia chips are thinner than its overall gross margins. We are looking at cloud margin on Nvidia chips being around 14% versus overall gross margins of 70%. Now, with all those deals between OpenAI and AMD, OpenAI and Nvidia, so on and so forth, how concerned are you about the circularity of the AI economy given the margins as well?
Well, the margins they mentioned, 14 versus 70, that's very, very stark, right? That's very pronounced. But let's take a deeper look. The AI economy today looks circular. Cloud players spend billions on Nvidia GPUs, then rent to AI developers who build models, then run back on those same clouds. Nvidia is capturing most of the value, which clouds like Oracle face thinner margins as they subsidize growth. The risk is that much of the cash flow is just recycling internally until real monetization from AI apps arrives. I know we talked about AI apps the last question, here we are again. But this isn't unusual. Every tech wave has a heavy upfront build-out phase, like internet pipes in the 1990s. for investors, the focus should be on where the pricing power shifts from Nvidia today to those who can turn compute into productivity in the years ahead.
Okay. And going back to the Singapore stock market as usual, Terence, how would you read into STI's performance today? Any surprises if we look at the biggest movers?
Actually, like you mentioned just now, there's like sea of green
in Asia,
across the globe, right? In Asia, it looks very exciting, but we really stuck out like a sore thumb. We fell 0.3%. I think that this is probably a healthy correction. We run very hard in September. A lot of people were very wary about September, but we did wonders. And then hit a low in September. But this month, that actually started running up again by as much as 4%, by over 4% actually. And like I said, this one is probably a healthy pullback. For surprises, I think not much. I mean, look through the list, but marine-related plays seem to be back on investors' radar. ASL Marine just did a placement, and I believe and that could renew interest in the sector as investors assess catalysts to propel marine players. Marco Polo has done very well over the last couple of months too.
And I do want to zoom in on another counter to watch being Keppel Reit, because the manager of Keppel Reit announced today that the private placement to raise about 113 million Sing dollars for the acquisition of Ryde City Shopping Centre in Sydney has closed. How significant, though, is this piece of news for investors looking at the counter's price movements?
I think from a market perspective, this is important for two reasons. First, it removes uncertainty. The placement was priced at 87.5 cents per unit, representing roughly a 4 to 5% discount to the last traded price before the halt. So investors now have a very clear reference point for dilution and funding. And typically, once the fundraising overhang clears, we may see some near-term stabilization or even mild relief buying in the units. Second, it signals a strategic pivot. Keppel Reit has been known more for its office exposure, like Marina Bay, some of these like trophy assets, the Marina Bay Financial Centre, One Raffles Quay. This acquisition of suburban mall in Sydney is interesting because it diversifies the income away from the cyclical office segment. The retail component, especially one anchor in densely populated catchment, could help smoothen portfolio returns and broaden the tenant mix. Now, in terms of price movement, the market tends to digest such placements in two phases. First, units may trade close to the placement price as arbitrage flows settle. Then, subsequently, performance will depend on how accretive the deal proves to be. Keppel Reit guided that the acquisition should be DPU accretive even after factoring in higher interest costs.
Okay. And Terence, across the region, you mentioned earlier, Singapore's stuck up like a sore thumb because it's a sea of green practically. And if we look at China, stock markets there opened higher after this week-long break. Investors opted to focus on the AI-driven growth over tepid holiday spending data. So if you look at the onshore CSI 300 up as much as 0.6% after the opening, what are you keeping your eyes on?
I'm keeping my eye on you, Tian Tian. There's 3 or 5 questions on AI. Anyway, it is AI story over the last couple of weeks, and especially since China closed off its market over the week and just reopened. So there was a mild rebound. It wasn't huge, but it's telling. I think traders are rotating back to tech hardware, semicon, data center names. All these are beneficiaries of Beijing's push for self-reliance in high-end manufacturing computing. But I'll be cautious about reading too much into this morning or just one morning's, right? Holiday spending came in softer than expected, suggesting that domestic consumption momentum remains weak. For the CSI, I'm looking out for 3 things. One is earnings guidance. Then there'll be policy tone from Beijing and flows between onshore and offshore market. If northbound inflows through Stock Connect pick up meaningfully this week, that would signal domestic confidence returning despite the macro noise. In short, today's update looks like selective optimism, but not one that is a full-fledged risk-on move.
And we want to talk about this piece of news that dominated headlines and papers for today, how HSBC Holdings plan to take Hang Seng Bank private in a deal that values the lender at $37 billion USD, ramping up its exposure to Hong Kong as the financial hub attempts to bounce back from years of economic turbulence. What should investors make of the move?
With this HSBC's plan to take Hang Seng Bank private, valuing it at $37 billion, I think it's one of the largest take-private deals in Asia. It really signals a strong strategic bet on Hong Kong, which is surprise. I mean, like many people have forgotten about Hong Kong or think that it's part of China. But now with HSBC's plans, I think it really that there's some shift back there. Already owning around 62% of Hang Seng, HSBC is aiming for full control to simplify its structure, integrate operations, and capture cost and capital synergies. The deal deepens HSBC's exposure to Hong Kong and Greater Bay Area, retail and SME banking, where Hang Seng has a very, very strong franchise. It also reflects a vote of confidence in Hong Kong's medium-term recovery, even as the city faces headwinds like soft property prices, cautious consumer spending, and slower mainland inflows. For Hang Seng shareholders, this buyout could mean this evident, right? With all the takeover, and at such healthy premium. So I guess to Hang Seng shareholders, especially the loyal ones who have been there for decades, right? This is really a good, healthy premium. For HSBC investors, though, the key question is whether the consolidation improves return, ROE, or merely increases concentration risk. Because remember, HSBC is very, very big in this area, in this region. And in short, it's a long-term strategic move that underscores HSBC's conviction in Hong Kong's role as a financial gateway to China, which was, the story for the longest time until the last few years. So now there seems to be a shift back.
Okay. And finally, before I let you go, Terence, let's talk about Netflix. It is making its video games available for play on TVs for the first time. Have to admit, I've not played the video games myself before. So what's your take on the move? And do you think Netflix is actually spreading its resources thin? Should it diversify away from the content it's been producing in terms of movies and dramas? Or should it deepen its presence in that? Can these two be mutually exclusive?
Well, I think...
A lot of questions in one. I apologize.
No worries. You said last question, but it seems like last question. Netflix moved to bring its video game into TV marks a new chapter in its ambition to become an interactive entertainment platform, and not just a streaming service. But all these integrated platforms, not new, right? So far, Netflix gaming experiments have been limited to mobile titles like Stranger Things or Love is Blind style type of games. But expanding to TV, that's a big step because that's where most users still consume Netflix content. It's about deepening engagement and keeping viewers inside the ecosystem for longer stretches of time. So whether, the question, of course, you asked, I remember out of the many questions, one is whether it is spreading itself too thin. I think that's a fair concern because gaming is very different business. It involves higher development costs, longer production cycles, and uncertain payoffs. But Netflix isn't trying to compete head-on with the likes of PlayStation or Xbox yet. The idea is to leverage its storytelling IP to turn popular series into playable worlds. If done right, gaming can actually extend the lifespan of its hit franchises and reduce churn, which is crucial in the saturated streaming market. That said, Netflix still needs to be disciplined. The core strength remains in premium storytelling and global content localization. Think Korean dramas, European thrillers, right? Those remain its competitive moat. Diversification only makes sense if it reinforces this ecosystem, not distract from it. And on the question whether they can do both, I think it's possible, but only if the games serve the content. Again, you can imagine the likes of Disney, which use Marvel, how it uses Marvel and Star Wars across films, series, games, and I think that's the integrated model that Netflix is aspiring to be.
I see. Lots to watch. Indeed, lots to watch. Also talking about those drama episodes to catch up on over the weekend. Thanks so much, Terence. That was Terence Huang, CEO of Asia Capital. Thank you so much for joining us today.
Thanks, Tian. Take care.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.